Hi, I'm Dan Hanford, founder of the Multifamily Investor Nation and managing partner with PassiveInvesting.com. I want to thank you for taking the time to watch this session, which was originally recorded from the Multifamily Investor Nation Summit from January 2020. We had over 1,000 attendees and over 40 speakers, and I know you're going to enjoy this session. I want you to also take a moment to go check out the next summit that's coming up. We do them twice a year, once in January and once in June. You can go to MFINsummit.com to find out more information about the next summit that's coming up. I also want to encourage you to check out our premium edition of our Multifamily Investor Nation group. You can go to MFINpremium.com and start your free trial today. I also want to encourage you to go to multifamilyinvestornation.com and find out other ways that you can follow us and learn more about investing in multifamily real estate across the United States. Thank you again for watching, and now you can sit back and enjoy this session.
That as we go through this, I was really excited when the team chose this topic. It's not what I expected. It's not the primary focus of my day job, but it is an incredible application of it. And so as she mentioned, what we're talking about is how to build lasting generational wealth. So I'll talk about a tool that has been used across the world and certainly been used in America by everyone who's been successful with multiple generations. One of the families that is always called out, first and foremost, it seems like in most discussions about this, is the Rockefeller family. And I'll talk about them a little bit as well. And there's a lot of very well-known families that have crashed and burned and failed when that was their primary goal as well. And so what are those destroyers? And the two big destroyers are taxes and our own family. And I don't mean to be negative about family. I have two beautiful teenage boys. I love my kids. I want them to be extremely successful. I want them to carry on my ideals. But nonetheless, those are the big things that are our risks. So when I talk about taxes, I'm talking about income and estate taxes. And when I'm talking about family, I'm talking about not being financially educated about how best to move forward and how to carry on the ideas and the actual dollars that were left to you from previous generations. Also, sometimes people get left money when they're very young and it wasn't intentional, but it's where they are and they're not ready to do it. And sometimes when they're in their 20s, they're still not ready for it emotionally. And so there's this thing about protecting them from themselves a little bit until they are ready for that gift that they've been given. And then there are just threats that we don't always see, but you can tell are out there for other families, and it's things like when a divorce happens, how do you handle that? And somebody who actually just wants to, is mad at the other members of the family and wants to destroy what has been built. So you want to try to protect from that as well. And I'm not an attorney. I'm not really good at the trusts. I have them in my life. I've helped many of my clients, facilitate them, getting them with an attorney. But the big part about these trusts often is not how they're structured, but what's in them. What are the words that are in there that will be left to the trustees when we pass on? And so I have a very, very close friend named Aaron Chapman who he is doing this for his family. I'm doing it for my family. And we're kind of figuring it out as we go along, trying to bring to the middle class what the wealthy in America have been successful at doing. You may have heard of a term, for example, called a family office. It was kind of new to me when I got into the financial services world about 5 to 6 years ago. And I didn't know what the concept meant, but it's actually an IRS term for people who have $100 million or more in their family. And it is just a specifically different way in which to handle taxes. But the important things in there, again, which is how to make investments, how to talk to your family, how to create a financial education program in your family for future generations is really, really important stuff. So that I'll talk about as well in here. So when you think about the taxes side of it, there's these three people I think come to mind for many, many people. So these were the richest of the robber barons, and we even labeled them robber barons because at the time people thought that these gentlemen were taking all of the money and they were being selfish, and I'm sure there was some of that. But I think when I look back on it, and many of us in our current generation look back on it, we see people who were more like Warren Buffett, and we have a different opinion now on the Bill Gateses and the Warren Buffetts out there, because somewhat what Andrew Carnegie did in and showing that you can be giving, with this wealth, and you can do a lot for the wealth. At the time, the guy on the top left was the first extremely wealthy person in America, in today's dollars had over $100 billion. And then he was a little bit older than the others. So that guy is Cornelius Vanderbilt, and he created the transportation systems in America, mainly around New York City, and spread out with railroads from there. Extremely wealthy individual. He has, mansions across America at the time. The Roaring Twenties had a lot to do with his descendants and his families. And she's saying, I'm not sharing my screen. I'm so sorry. Let's try that again. So here's here we have the robber barons I was talking about. And so Cornelius Vanderbilt on the top left, next to him, Carnegie and Rockefeller. So Carnegie and Rockefeller are a little bit younger than him. They were really the late 1800s. And both of them were around at the same time. They were competing. They were doing business together. Both were extremely wealthy. Rockefeller is the guy who took it to over $200 billion in today's money. And so taxes had an impact, a very different impact in these three gentlemen's lives, which is why I'm bringing them all up. And then, of course, the other aspect of it was family that I mentioned. And so family can have an impact, right? And so I pick on someone here, Miss Paris Hilton. I have nothing against Paris, but she happens to be a very, very popular figure. And she's actually running some businesses now and being successful. But there was a period of time in her early 20s when I think that immaturity was there for her as well. She was doing some crazy stuff. And I would say for sure that her great-great-grandfather, Conrad, would, I'm fairly confident she was not using money the way in which he had used it throughout his life. So I just bring it up as this visual image, kind of an idea of how without the right kind of education, people can do a substantial amount of damage, or at least go in a direction that was not thought of. And so again, we go back to like those trusts and having language in there about what the money can be used for, and what level of financial education you have to reach before you get there is pretty important stuff. If we go back up to these gentlemen, so the only really famous survivor is listed here for the Vanderbilt, the Vanderbilt family. And he had to get into television on his own merit, right? I mean, there's no one else left from the Vanderbilts. Andrew Carnegie, the same is true. They had a number of years back, they had a reunion for their Carnegie family at Carnegie Mellon University. And there was not a millionaire in the crowd, even though there were over 50 descendants there. Some of that was kind of intentional, though, because Andrew Carnegie really, really pushed. He created the library system in America, and of course he started all of these universities. So a very, very giving guy. But so he gave away some of that wealth, but he did not give away. Sadly, he did not give away his knowledge about how to grow money and how to protect money. And there was a lot of things that his own descendants have talked about over the years. They never got that passed down, right? So a very different family is John D. Rockefeller's family. They're on their seventh generation now. And they have obviously a very prominent building in New York City. They have a foundation that gives away hundreds of millions of dollars, every year. And then we have a Vanderbilt descendant here. It's awesome. So another famous person, Adam, great job. So, the Rockefellers, he's been called a robber baron. He's been called stingy, right? But one thing I don't think any of us will take away from this is that he got right the idea of how to pass money and protect it, and mainly from taxes, right? Yes, educating the family protects it from the family, loss in the family, but it creates a legacy that's lasting. And so Carnegie is very famous for saying, he who dies rich dies disgraced. And he's done a tremendous amount for wealthy people's mentality. Warren Buffett giving away half of his fortune to the Bill and Melinda Gates Foundation. He's just done tremendously amazing things with that money. And I think you can credit a lot of that back to Carnegie and him just standing up saying, I'm doing this, you all should do it as well. And he had a big impact on John D. Rockefeller and his family. And so the result of that is when you marry together the ability with trusts and other things like tax-free vehicles, then you can protect money from taxes. And if you do it right, you can teach the family how to protect it permanently going forward. So, their family, you can look at it in 6 or 7 generations, millions of dollars to charity. They have a process in place to protect the money from taxes, and they have a process in place to educate the descendants. And you can see the impact of it, right? It has had a tremendous benefit. So I'm going to take a quick step back. So who am I? I'm a kid who grew up in the 1980s in high interest rates in Illinois on a dairy farm. And why is that important? Well, I can relate very well to these robber barons, especially to Carnegie. When I've studied that man, he had at age 14 had 2 jobs, and he was trying to help feed the family, right? And that's what I did every day after school on our farm. And you know what? I hated it. I wanted to get away from it. And so what I did is I got an opportunity to go to the Naval Academy. And what I liked most about that was a safe, secure job that was going to help me build a mountain of money, which frankly in the 80s, 90s, and 2000s is what we all thought was the right answer. You build a mountain of money, it will protect you, and you can live your life retiring early. There's a big desire out there, or an acronym, FIRE, financially independent, retire early. I mean, everyone has that desire, right? And we thought a mountain of money would get us there. And so I focused on getting a nice, secure job, doing really well in school, and a lot of stuff that Robert Kiyosaki rails on. And I'm betting with a bunch of real estate investors here. You guys have all read his stuff, and you can kind of relate to some of this. I had a tremendous time commanding a nuclear submarine, and in my 30 years in military service, I loved it. I feel like I loved my crew. I will never, ever regret those memories. And I feel like we did a lot of great things to help keep America safe. There was something missing though. And when I was finishing my command tour and doing some relating back to why is it never enough? Why am I always trying to climb the ladder harder? Why am I not spending any time around my family when I could, when I did have a mountain of money? And what I realized was, thinking back, that, I was embarrassed to go to school in the vehicles that we drove back then because we were dirt poor. And I was embarrassed to wear the clothes that I wore to school. And I attributed all of that to getting a mountain of money and it'll all be solved. But you know what I really realized was that this guy right here, and being forced to spend all of that time around him and learning those lessons from him, are the things that I don't think Paris Hilton got from great grandpa. And they were things that my kids, more importantly to me, they were things that my kids were not getting from me. And so I made a change. I left the military early. I stepped off of a very fast moving train, and I started focusing on my family. And I started I started a decade-long search for, if it's not the money, if it's not a mountain of money that keeps us safe, what does keep us safe, and what is the key to being able to pass this forward to other people. And so I'm going to try to share with you what I think I learned on that. There's a tremendous book and an advisor that I met at Paradigm Life when his company was small. His name's Patrick Donahoe, and he wrote this book. It changed my life. It's changed the lives of a lot of my clients. It's a very easy read. It's kind of like Rich Dad, Poor Dad, with a lot of the same kind of technique of simplifying things. If you go to GaryPinkerton.com/MFIN, you can get this book for free. And I think there's an audiobook version of it as well. The reason I pointed out at this moment, though, is because there's a pyramid in there that we adopted from Maslow's hierarchy of needs, and we call it the hierarchy of wealth. And it's using the same kind of analogy that Maslow uses, which is that you need to fill those things at the bottom. If you remember Maslow's work, he said that food, shelter, and clothing is tier 1. And if you don't have that solved, you really aren't caring about community and making a difference and self-actualization at the top. None of that stuff really matters if you don't have the foundation built. And that's what I do in my day job, is in the financial world of Maslow's pyramid. I help people build a foundation that can allow them to then take the next step and think about passing stuff to our family and what's really important in life. And that's what Patrick helped me do several years ago. And the path I took was, following that and first putting my foundation in place. And so in the way in which we talk about this in that book and the way I talk about it with my clients, again, tier 1 is a foundation, and it's about putting in place emergency dollars and putting in place protections. And tier 2 and above is about investments, and there's different kinds of investments. And the premise here, as you can see, is that the risk on the right-hand side, the risk goes up as you go higher on this pyramid. So that's what defines what level different things are in. And the reason the risk is getting higher is because your level of insight and control is going down. So things that you're directly involved in, things that you get direct reports on, are in the second tier down there. And then things that you're less involved in are in higher tiers. And so to for a moment, kind of put this into perspective for the investments so you understand what I'm talking about, I'm going to put this guy here, right? So I said that I went off to get a safe, secure job and studied law in college. So this guy's a college graduate, right? But that's not really the point of it. The point is that this individual invested hard work, time, and probably money in improving themselves. And one of the most important things that I've learned in my last decade of life here, it sounds like I'm about to die. In my 40s, what I learned was that the most important thing that you can invest in is yourself. There will never be anything that parallels to that. You are your number one best asset. And we talk about that in Patrick's book, but that was my aha moment that I got 10 years ago, which led me on this path that has been absolutely fantastic for me. So anytime that I think about putting money somewhere, putting time and effort somewhere, I look at the pyramid and I say, where is it? Where am I specifically on the pyramid right now? How many bricks have I put in place? And then where is this new venture on the pyramid? And if it's a tier 4 thing, for example, and I'm still filling out tier 2, I shouldn't be even talking about it and I pass on it. So, the most important thing to protect is yourself, your ability to have great ideas, your ability to have time to implement those ideas, and your ability to, again, gain value from what you add to the world. So focus on yourself, bring value to the world, and the world will give you everything you want to worry about. I love Zig Ziglar's comment, or his well worn out phrase, that you can have everything in life you want if you just help enough other people get what they want. I'm huge in service. I'm huge about sales because it's adding service, it's adding value every day to people. So those of you that are out there wanting to be multifamily investment syndicators, I think you're in a tremendous world because you're turning people away, turning people towards something that is a tier 2 or tier 3 kind of asset, and you're getting them focused on things that are fundamental, and you're helping them get around their kids. And that's why I'm so passionate about doing this. So next to that, is your own business. A business is an extension of a person, right? So the reason Facebook was so successful is because Mark Zuckerberg was successful. The reason Apple was successful is because Steve Jobs was amazing and that business was an extension of him. So if it's about building your business, like, turnkey rental properties or multifamily properties, then you're in the right place because you're focusing on you, your knowledge, your connection, your network, and by an extension, your business. So keep doing it, right? For me, initially, it was single family homes. I was buying 1 to 4 family properties. I still have them. And along the way, I realized what I really want to do is this, which is foundational work, which is tier 1 work, because I want to inspire you all to operate in tier 2 and tier 3 for other people. And so tier 3 then is when you've built that second level of directly controlled assets. You've worked a lot on yourself and you have maybe more money or more resources than you have time. And so you start becoming a passive investor in other people's deals, right? And sometimes you come back from that. Like I'm a passive investor in multifamily. Probably a lot of you started out that way. Maybe that resulted in you starting a business and expanding out on tier 2 down there, right? But I think it's important every time you think about, I'm considering going to do something here. Do I have the time to do it? Do I have the money to do it? And if so, first, what tier is it in before I take that leap? The 4th tier is called speculation. It's where you have very little control or understanding or insight. I put the markets here because for most of us, that's a really good description of the markets. You're sitting at the bar, your buddy says, hey, have you heard about this stock? It's doing amazing. And you go buy it, right? You don't know who's in charge of it. You don't know what decisions they're making. You don't know anything other than that it's a hot stock and it's moving in a given direction. It's a lot different if you work for that company and you understand the products, you understand, right? So the risk is coming down because your level of control and insight goes up. So it's not about whether it's the markets or the real estate. It's about your level of involvement in it and how that sets you up with reduced risk to be able to be involved. People say all the time to Robert Kiyosaki, and he said this to me numerous times on trips. He said, hey, there are no bad investments, right? There's bad investors. And that doesn't even mean that the person's bad at what they're doing. It means they're in the wrong thing. Like you want to see a bad investor, like have me go out and start buying land and doing oil and gas. That's a bad call. I don't know what I'm doing, right? And it's not that oil and gas is bad. It's that I'm the wrong guy to do it, right? And hopefully that makes sense. So what do I do for a day job, right? I help people put in place this foundation. So just to leave this though, with a few colors thrown in here and maybe some examples of things. So for me, it's real estate and my own business, right? And this is just a way to kind of wrap up what we just talked about. And so the idea is that you protect and grow wealth down here and you access that wealth from time to time to make investments in the investment levels up here, and it brings back money. You build out a larger foundation, which supports a larger pyramid, and you repeat the process. That's the concept. And the idea also is that if you're up here playing around, which I play around up here sometimes, and I fall, well, if there's a good foundation underneath it or a good tier 2 underneath it, then I don't fall too far. So that, is a really good start to the concept of why do I do what I do, and why do I push people to put a foundation in place underneath everything? So many people I know today and I meet today are completely in speculation. It's the only place. It's operating up there with nothing underneath it. They have all of their money, for example, in company stock and not in their own company, that just in stocks and bonds and mutual funds that they know nothing about and that they're not paying attention to. They're offsetting that to somebody else. Yet they're heavily in debt and credit cards and stuff. And so they don't have a foundation of savings to help prevent that from happening. So it's my goal, my job to get people's pyramids upright, get a foundation underneath it so they can share their unique genius with the world. I mean, all of us are really, really, really good at something. And I'm guessing a lot of people listening to this are really good at raising money, finding deals, and putting investors that are going to love them forever into multifamily deals. So if that's your unique genius, set your life up so that it works for you, meaning have the foundation, get the tier 2 in there, and focus on that business. So we have a lot of potential in our lives. Going back to this, who's your number one asset, right? Our number one asset is ourselves. And, this 42-year-old guy is my example that I'll run through today's kind of example or today's scenarios. Let's say that they're making $150,000 and they plan to retire, at age 65. And their income is going to go up by 3% a year, let's say, and they have $100,000 in savings right now, and they have a place where they can save it without taxes, without impact, for let's say 6% a year. Well, the numbers are pretty staggering when you look at that. I mean, this is only a 30-year period of time, but this person's going to bring in $5 million through their fingers. $5 million is going to flow through their fingers during that period of time, just in salary alone, right? Or in the value they add to the world. And if they do a nice job and can protect it from the number one stealer, which is taxes, and they can get efficient with their world, that can be grown very easily to $10 million just with that 6% growth. Nothing creative, not being invested in real estate where you get the tax advantages and you can get 12, 15 or more % return, right? So this is a very simple example and a very easily achievable one. Most of us don't back up and say, what's the $5 million asset in my world? We don't say it's ourselves, right? It is. That's the asset. No investment out there is ever going to come close. So the other thing we first should figure out is if we're going to build a foundation, like where do we put it? Like what does it look like? What kind of bricks do I put in that foundation? And so I want to take just a moment to talk about why I put mine where I do. And, if you really got things distilled down to the basics, what I would say is that there's 3 different buckets of money. There's a pre-tax bucket of money, which I call Congress's playground. I call it that because it's where most of the money is today. And every time Congress or the president need to reduce taxes or do some kind of an incentive, the question is always, how do you pay for it? And, stealing the phrase from Willie Sutton, this goes way back in the 1800s, right? 1700s maybe, when they said, Willie, why do you steal money or why do you rob the banks? And Willie says, because that's where the money is, right? And so when you ask Congress, why do you keep changing the rules with a new, retirement legislation that just came out a few weeks ago? Why did they change the rules on stretch IRAs to make the next generation spend that money or distribute that money and pay taxes on it in the first 10 years? Why can't they stretch it out over their lifetime anymore? And Congress would have to answer, because that's where the money is. That's where the trillions of dollars in the US are that they can access when they need to. It's in those accounts. So I call it Congress's playground. Are they going to take it all? I'm not saying that. I'm not a tinfoil hat guy. I'm just saying that's the place where it's the only place they have a choice to go get money when they need it. Post-tax money. So this is money that's in a brokerage account, it's in your savings or checking account. You've paid money on it, or you've paid taxes already, but you may have to pay taxes. I mean, you will have to pay taxes somehow, capital gains or earned income on any profits that you make. And then there's tax-free, right? And for me, tax-free is life insurance. In today's regulation, it could also be Roth IRAs and maybe a couple of other types of vehicles. But the big one, the one that the wealthy put a substantial amount of money in and that I put my money in, is permanent life insurance. And it's because if you operate it correctly, like the Rockefellers and their trust, the primary key reason the Rockefellers Foundation and the family have been so successful is the decisions they made when the US tax code was coming around. And one of them was to store a bunch of money in life insurance. And they've perpetuated that for centuries, or for decades, excuse me. So if you were going to take 80,000 out of one of these accounts, for example, you would get taxed on it. And if you're in the highest tax bracket, you're spending only about $50,000. And if if your money was not as much tax, so you'd already paid taxes on some of it, it's just the earnings, and maybe that's even in a capital gains rate. So you're saving a lot more, you're able to spend a lot more in that one. But in a tax-free environment, if you've stored the money there, all of it's coming out without taxes. And there's a lot more benefits as well. Like your Social Security gets taxed in retirement depending on what you make. Well, if you're distributing 80 grand from here, your taxes are showing that you're not making any money, and therefore your Social Security also is not getting kind of double compounded and taxed as well, or double impacted. So, the question I ask when you look at this thing is that if you're setting up your legacy and you're talking to your kids and your grandkids about where to store and grow their money, what bucket are you telling them to put it in? I was saving money for my kids in 529 plans, and I was saving money for them in traditional banks, which would be, the left-hand side and the middle side. I've changed it completely. And I talk to all my clients, and this resonates across the board with my clients, that it's time to start talking to our kids about how to protect our wealth generationally. So I meant to mention that if questions come up, please do just put them in the chat window. I do have it up, and I'm monitoring it. There's different places. So for this foundation, there's different places we can store and grow wealth, and it could be money for future investments. It could be our family's emergency money. It could be money for college. We have reasons to store money throughout our lives for our entire life. Right now, I'm storing money looking for the next market correction so that I can use, the environment that I remember first investing in 2011, 12, and 13. Things were different. They will reset again. And right now I'm storing money to be prepared for that. But when you look at these different things, some of the questions you're asking are, well, how safe is the money? How liquid is the money? What's the rate of return? And how is it taxed? And the reason I made the decision to go with the one on the bottom of this chart, whole life insurance, is because it met the mark on all of these. Some of them are kind of questionable, even with the thumbs up that they have. And I'd be happy to answer those questions in the chat window or in just open questions as we go into this. If you have questions about why I put them in the brackets or in the little categories down here that I put them in. So I'm big on moving the power of compounding to your favor. So a guy out there that I think does a tremendous job, but he has a very strong voice and he doesn't like the products that I use, insurance-based things. And his name's Dave Ramsey. And I think he does a tremendous thing because he is helping people who are down here get back up onto safe ground. He gets them up here so that they're, if you think about people in quicksand, that's somebody who has, for maybe because they couldn't deny their self from, getting something early, delayed gratification, I guess is the phrase, right? Or maybe they just got in trouble. They had some big medical bill or something, or lost their job and they got in trouble, but now all they're doing is servicing debt, and eventually you can't do that and it spirals, right? That is the power of compounding working against you. So he helps people figure that out. He helps people get back in dry land. But he stops the story here at saving. He says that you should always pay cash for things, right? And you should save and spend and pay off your home and do stuff like that and not use leverage. And I think everyone who's here who is focused on multifamily real estate knows that there's a step beyond that, right? And the power of compounding works in both directions. And so when you can take the lessons learned to get you to that and use it to do that, that's when it starts to make a big difference in your world and for the future generations. And so that's what life insurance does for people. Specifically, after a short capitalization period, you're essentially where you would have been in your savings account. And then when you access the dollars, you can do it in a way in which you don't take the money out and you don't interrupt the compounding. And if you can actually do that, you can get the value of the dollars to make an investment, to purchase something that you needed in the family, but you don't take the money out. That starts to have a huge impact over time. Here's one quick example. If you were going to save $1,000 a month into a savings account and periodically access those dollars, dump them out of the account, and then continue saving to fill it back up, then that's really represented in the red down at the bottom. But if you're able to somehow access the power of those dollars without taking the money out, then it continues to compound in the background while you're doing it. And that money, $1,000 a month growing at 6% is $1 million in 30 years. So, I invite you to just kind of think about that and just go back and think about the power of compounding working on your behalf can do what it's done for the Rockefellers. It will cause generational wealth to grow in a tax-free environment. It's powerful. So another thing that happens is that from time to time, I will use it to make an investment. And when I'm going to put a $20,000 down payment on a rental property, or when I'm going to put $100,000 into a passive investment in a syndication, the question is, if I put my own money in there, again, I'm giving up what it can do for me. But if I could somehow borrow money from somebody else and pay them back with the cash flow throughout time instead of refilling my account, does it make a difference? And the impact is that you have an opportunity cost when you put your money into this investment. If it's a 15% a year investment, then it's obviously a really good idea to do it. But if I could somehow not have that opportunity cost of 6%, meaning that I stop my money from growing like that, then it's even far better. And so again, down here, it shows that if I borrow $50,000 and put it into an investment, and I pay back 6% interest to somebody else for doing that, then I've paid them $46,000 in interest, right? I've far made more than that in the investment, but that's what I've paid over 25 years. But my money in the background has grown $164,000, almost $165,000 in that period of time. So that's just a snapshot. This is not magic math. I would gladly go over it with you one-on-one. It's pretty simple to do. There's no tricks here. Power of compounding, operating, and figuring out some way not to interrupt the compounding in your life and not to have taxes impacted are pretty doggone important. So, I call it the and asset. And you've probably, if you've come across this approach of using cash value life insurance as a banking system, it's not just about legacy. It's about growing your own family's wealth while you're around and using it as well. And so from time to time, you add cash to this. You can replace your savings. You can take it to different levels. Most of my clients just decide that they're going to save 10, 15, 20% a year, and they're going to save it in this vehicle now instead of other, Congress's playground type vehicles that they previously were at. And then when you want to go on a vacation, you can borrow or pay for some education or purchase a car, and then you can continue to rebuild and pay those back. The money that you borrowed from the insurance company or from a private bank using this as collateral. So the key is that you're not taking your own money out. You're taking somebody else's money, and you're using your cash as collateral while it continues to work in the background doing what it's doing. I like using it though for the stuff on the right-hand side because these have a ready-made way to pay them back. It has cash flow, right? So your cash flowing investment is then being used to fill things back up. There's a lot of misconceptions, a lot of misunderstandings. I'm on Bigger Pockets all the time. I understand that there's a lot of them there, and where I can, I try to engage and try to explain things. But some of those misconceptions I had as well. One of the important things is to understand that not all life insurance is created equally. And for the privacy and protection and mainly protection side of things, I stay away from anything but whole life insurance. I always have. And the other thing is that I don't just do a generic policy, right? It's heavily modified to make this work, and you need to work with a professional to do it. And some of those key things are written on this page right here. You really need to stuff in cash into the policy as much as you can. Focus on the cash side, not on the life insurance side. You need to minimize expenses and charges. You need to have something that's really, really flexible to operate. And you need to have access to it without taxes. And then, reinvest it while it's still earning and allow it to continue to compound your dollars, compound by accessing the insurance company's money. So here's a picture of how every day for dozens of clients, I adjust what is a normal life insurance policy on the left-hand side and turn it into what I call maximized whole life at Paradigm Life. Maximized whole life insurance. And the reason we do this, the reason that we focus most of it in that green area, and often I go more like 80% of the money there, is because it's much more liquid and it's much more flexible when you put it in that area. So again, if I could get away with it, I'd put all the money there, right? If you were going to create your own banking system, you'd want it to be completely liquid and flexible on contributions and you'd want it to grow in that tax-free environment though. So to get it in the tax-free environment and keep it there permanently, there has to be a little bit of it that's going to that main insurance policy. And don't get me wrong, the money that's going in the blue is going to grow and compound in a tax-free environment, and there will be far more there than you've contributed in your lifetime. But it's limited access in the first couple of years is what causes me to limit putting that money there. But when you hear people say, yeah, but you don't get any access to the money at the beginning, they're not designing it this way. There's a misconception on just how it can be operated. And I pride myself in working with real estate investors, business owners, and optimizing this stuff as much as we possibly can. From day one, I borrowed against my policy $80,000 on day one to buy a property. And I've never stopped. I've never paid off the loans on my property. I mean, on my policies now, 20 plus loans that I have outstanding. So probably something to get any more granular than this, we'd want to kind of, go personally, individually, and talk about it. I do have an example in here later. If somebody wants to see, numbers examples, I can put that up, but it gets detailed and gets people to have their heads swim a little bit pretty quickly. So I've kind of stayed away from it on the initial blush here. So, what's the catch? People ask me that all the time. Hey, this sounds too good to be true. You're telling me this stuff's going to grow 5% in a tax-free environment, and I can access it for whenever I want and pay it back whenever I want. Yes, you can do all that stuff. And yes, it's going to bring privacy and protection, and it's going to bring death benefit that otherwise wouldn't be there, right? It seems too good to be true. Well, it's not too good to be true. It's been used since the early 1800s. And as I mentioned, the Rockefeller family started using this in the early 1900s, and it has made all the difference in the world. There's more than just Anderson Cooper that is famous in his family, and they've given away hundreds of millions of dollars. And it's because he understood what was coming in the tax code, and he set his family up to protect it from it. So can we do the same thing since the tax code's already here? Yeah, it might be a little bit slower, but it's still fantastic. And the wealthy today have never stopped doing that. It's my mission, my goal to bring it to the middle class. So what are the catches then, right? So it is life insurance. To be able to use this wonderful asset that we have here, which is to insure our lives or insure family members' lives, we have to be somewhat healthy, or the insurance company won't do this partnership with you. There's a capitalization part that I talked about in that one picture, right? It could take 5 to 7 years for there to be as much money in there as you've contributed. But again, you've got immediate initial access to 75, 90%, depending on how we design it. There's limits on it. We talked about that, right? You can only put so much in the green part. But listen, if you don't need early access to it, and I do, and most of my investors do, then just putting the money in the blue section, and then the old school whole life insurance policy is still going to grow wealth tremendously fast for your family. And then it has to be properly structured, which we talked about. So I'm going to skip this one, but I do have kind of an accumulation strategy and some charts and stuff if we want to kind of go over that, or I'll just flat out start drawing pictures like I do for clients one-on-one every time when I meet with them. I just want to kind of end with the opportunity to give plenty of time for people to ask questions. And just a reminder that this book was really, really good. And I would ask all of you, think about going and grabbing it. It's, of course it's free. And I've got my team at Paradigm Life promising not to come hound you. When you put in your information, they won't hound you, and you'll be able to talk directly with me and meet directly with me. So I'm forever grateful to Patrick Donahoe for helping me be on this path. I'm grateful for what it's done for my family, for my kids, and what I'm able to do every day for my friends and my colleagues and my clients to be able to introduce their families to what I think is going to be extremely successful. So with that, thank you. And let's see some questions, please. And I would absolutely send you a copy of these slides. Yeah, Bethany asked that. Absolutely. And I think, I guess you all are in kind of listen only mode. I don't know if you can share microphones or not. I'm not sure how that works.
No, I think we'll just open it up.
Okay.
If you have questions, do you have the Q&A box opened up, Gary? Because
I
there's
do,
a question
yeah.
in there. There's one question there. And then if everyone wants to ask some questions, it's been a great presentation so far. So I'm excited to see what everyone has to say.
So Melissa, I think maybe I don't have the Q&A box open. What I see is the Zoom chat window. Is that what you're talking about, or
Yeah,
Q&A?
here, I'll drop it to you 1 second.
Oh, look at you. Here we go. All right, awesome. All right. Okay, so do you think modern technology can provide the transparency and access to investment performance needed to turn tier 3 and tier 4 investments into tier 2? That's an awesome question. I am, even though I ran a nuclear submarine, so in my partnership with Patrick Donahoe, he is a quick start genius. And I'm on a board of directors with him, and he's really, really good at technology, and he's just a visionary, and he loses me very quickly. So I should ask that question to him. What I would say in my experience, this is definitely a low tech answer to that, is that it's not about the, I did say it's about access and control, but what I learned in my own life is that I had the ability to manage my mutual funds. I had the ability to pick the right stocks. I was smart enough to do that. I wasn't doing it. It was not my forte. And so it was more about moving the assets into something that I actually was going to pay attention to. And that's why I moved to real estate, because I understand real estate. I was interested in real estate. And I was failing elsewhere because I didn't want to pay attention to it. I knew I was never going to do that. So I think it's possible today with current technology. I just don't think people do it. I think we've been sold a bill of goods that we wanted to hear. I mean, listen, if the FDA comes out and says, new study, you can eat ice cream and get healthy from it, I would be all over that bandwagon, sadly. But it's true that we've been told, listen, you're not the professional. You focus on your day job and hand off your money to somebody else. The same could be true for real estate, right? And it goes bad there too. So I think it's about maintaining control. We have to maintain control of our assets. And yeah, I think technology can put it in a situation where we can be in control of those. It's just about the fact that we're not. And people have told us we don't have to, and they're wrong. Is it feasible to start for a teen? If you're talking about life insurance policy, absolutely. I do it all the time on 1-year-olds. Absolutely. And I started with my kids about age 8 and 10 to fund their college with it. I got 2 things going on here. So, so I think, so that was just Melissa kind of dropping stuff over here. Okay. So continuing on here in the Q&A blocks. All right. Would your strategy premise work as well for a 65-year-old as compared to a 40-year-old? So because of much higher cost of premiums, I'm smiling because I just listened to this awesome thing from Zig Ziglar, one of his little skits where this lady comes up on stage and she's like, I'm too old. I'm never going to make it. I'm not going to make anything in life. And he's like, well, how old are you? And he was like 71 at the time. And she says, well, I'm 58. And he's like, well, honey, does your mama know where you are? And I just love that Southern gentleman. But I have people in their 60s who ask me that question. I got people in the 40s who say it about their 20s. And I got people in their 80s who are like, if I had just known this I learned this when I was 65 and I didn't take action, if I had just done that. Every year it would have been better when you were younger and healthier. But every year when you look at it and you turn around and you look at the landscape, I mean, I just turned 50 and I tried to get my policies in place when I was in my 40s because it made a difference. But I just bought huge policies because today, and I think it's going to be true when I'm 65, Nelson Nash, one of the guys who made this very popular, just passed. And when he was 80, he was buying life insurance like crazy because when you look at it compared to other assets, other options, it still makes more sense. If you could go backwards, it would be better. So hopefully that helps answer that question. Absolutely. I use on 65-year-olds all the time. I've got a dozen in underwriting right now, and they're extremely happy. Okay. I talk fast and I've already ran us out of questions. So if you guys would like, we have a couple more minutes. I have a few extra slides in the background. So if anybody wants to toss out just a question of something you'd like to see, want to see numbers, want to see a real estate example, something like that, would be happy to do it, or to go back over and explain again one of the other questions. So, while I'm kind of, it looks like maybe I'm not dialed all the way down. Okay. How do the dividend payments work? Great. So there's different things you can do with the dividend. So what he's talking about here is that, and I didn't say this yet, but I work only with mutual insurance companies. So if you think about a mutual company, I grew up in I said on a farm, and there was this thing called farm Farm Service, I think it was FS. And the farmers were like mutual owners of this company. When you bought stuff there, you got kind of ownership of it. And so the same thing happens with some life insurance companies. There are no stockholders, there's no shareholders. And so when you, when at the end of the year, when Mass Mutual, New York Life, Penn Mutual, when they give out the profits at the end of the year, it goes back to the policyholders, the permanent insurance policyholders. And so you can do a lot of things with those dividends. You can say, hey, I wanted to just get reinvested to purchase more of the green part of that picture and have it grow. And that's what we do normally at the beginning because it continues to grow and compound in a tax-free environment. You can also tell them, hey, I want you to pay the base premium with it. I want you to pay off my loan with it. I just want to receive it as a check. Maybe when you're in retirement and you just want to take the distribution. So hopefully that helps. But it's the amount that you get in the dividend. You may have been asking like, well, how do I know how much I get? The amount you get is based on how much cash you have. So it's a pro rata basis, almost like shares, if you will, like your cash value is how much of the shares of the company that you personally own. So we'll see if that works or not, Danny. Hopefully that works. My awesome client, Danny Randazzo. Hopefully you didn't mind me saying that, but love that man. Adam Fee. So what's your experience as an LP, limited partner in real estate? Very new. I invest with, so when I went into apartment buildings, I'm in 4 apartment buildings right now. And I've also done self-storage. I've done oil and gas, and I've participated in a couple of mobile home parks. One as a lender, hard money lender, and one as an actual investor in the park. And thankfully, everything but the oil and gas in that discussion, I first learned this. They've been recent, and I've learned establish a relationship with the individual. And once you know that person really well, and you know them to be ethical and intelligent, then do your investing with them. Now, when I invest with people that are heads of this organization, I don't ask about the deal. I'd ask about the person and how they feel about the deal, because I've lost all my money with people who are unethical, and it wasn't about the deal. And so my experience has been tremendous on everything but my oil and gas. And it's not about the industry. It's about, I wasn't experienced enough. And was I satisfied with the reporting transparency of my general partner when I was doing the investing? Yes, I am. Because again, I went with the people first. That was by far the most important thing for me. And I do that now with everything in life too. People I spend time with, people go on vacation with, people in my family I talk to at at reunions. Okay. So do you think, this is from Adam. Adam's my best question asker. Adam, do you think the lack of transparency and heavy paperwork turns would be real estate investors off? I think probably you're talking about is the PPM and private placement memorandum and the executive summary and all of that stuff. I mean, yeah, it could, but listen, that's just a sales game. I mean, you want to talk about turning people off, try to sell them about planning for their death, right? I mean, life insurance is not a sexy subject. So it's about connecting with the individual and helping solve their challenge. Amount of paperwork is no big deal. You can walk somebody through the paperwork. It might turn people off, Adam, but it's only because the person who's talking with him has not yet found the individual, the investor's why. I mean, you address that investor's why, you don't have to worry about how much paperwork is there. I think you guys can probably, I'm out of questions, and I know we're probably getting a little near the end. I have time to go as far as I'm allowed to before you pull the plug on me. I'll just talk here before, while I'm waiting on a couple of questions to come up. I think you guys can feel that, where I'm impassioned about this subject. I'm very much impassioned about getting people to wake up, to break the trance. And that trance is that you can just hand off your money to somebody else. And those of you that are out there raising money, I mean, never forget that topic, right? I never forget it when I have clients entrust money with me. And it's the most important thing to remember is that I have to continue adding value to them or they walk, right? They're going to walk away if you don't do that. So most important thing, continue to add value to people and convince people that they are their own number one best asset, and to make sure that they're surrounding themselves with good people. Some questions came in. All right, Adam, do you think, we did that one, I'm sorry. So Michael, cash value in the policy. Can it be used like a self-directed IRA into a variety of investments and the cash value grows without the account? Or is it a simple withdrawal and any profits made are outside of the policy, then money is returned. So very good point. So it is not like a self-directed IRA. And when I would say self-directed IRA, what I would say is a Roth, right? So if you look at pros and cons of Roth and life insurance, there are some things that are better in Roth, and there are some things that are better in life insurance. And that assumes we don't change the rules on Roth, right? So what is really good in Roth, for example, is Bitcoin, like, or investing in a buddy's business that may go 1,000x at some point. Something that, in my opinion, is not that great in any self-directed account is real estate, because it already has the tax advantages. Those advantages are going to be protected. So I don't do that. I borrow money from an insurance company, put it in my real estate, and let my real estate stand on its own, because I don't need the tax advantages for real estate in there. And it's so limited on being able to borrow as heavily to be able to leverage it as much and do personal work on it and things like that, right? So I don't like the prohibited transactions. And again, I'm a little bit worried about them changing the rules. But no, it's not like a Roth where if you have this massive gain, it stays inside that asset. So that is a good point. So what type of policy, from my buddy Danny Randazzo, what type of policy do you recommend for someone who's 35 and has $50,000 available to start a policy? And how does it work out? So, okay, so that's one piece to the puzzle. So one of the things about this life insurance that we talked about up here is that we want to put as much as we can into the green and as little as we can into the blue. You can really exaggerate that, like to the point where if somebody comes to me and says, well, what I said, Danny, was that it's one piece of the puzzle. As you know personally, one of the second part of the puzzle is, what does it look like in year 2, 3, 4, 5, 6, right? Like, what is your propensity to be able to continue saving into this vehicle? One of the things about this MEC limit, this IRS red line up here, is that it has this really weird 7-year component to it. I think it's weird. It's just like, you ever wondered why 27 and a half years for residential real estate is the depreciation schedule and 39 for commercial? Like, where did 27 and a half come from? I'm guessing somebody on the right-hand side of Congress said 25 and the other guy said, and they just said, it's late, let's compromise. But this is the same kind of thing, 7 years. If you contribute into a life insurance policy for 7 years, then they say, okay, if you've contributed to the blue part for 7 years, it's good, it's life insurance. But if you try to do it less than that, if you just put one big lump sum in and that's all you do, unless you get a creative guy, which I hope I can be for you, if you don't get a creative person to be able to make that work correctly, they're going to say, that's called a single premium test and you fail, and it's now basically a 401k kind of taxation. You touch any of it, you get taxed on it. So, and you have early penalties before 59 and a half. It's not something my clients ever go to. So to kind of answer Danny's question a little bit differently is, I don't want to say it depends, but $50,000, I would put it in something where you can access almost all of the $50,000 immediately. And then I would make sure also, more importantly, that the ongoing minimum contribution on an annual basis works for the family. And that's why I'm asking for your financials and why I'm asking for things like, how much do you save on a monthly basis? How much do you save on an annual basis? So great question, Danny. And the other thing I want to mention is that a lot of you here are syndicators, right? And you're doing an amazing thing by introducing an alternative class to people who just don't think there's any alternative. And I will be forever grateful to all of you for getting people to be able to pursue their unique genius in tier 2 and 3. And so keep doing it, please. But you're going to have some investors that this would be a good value add for. And I would be forever grateful if you introduce me to them. And the reason I say it is because I'm always looking to introduce my clients to people as well. And the reason I do that is because once they have their life insurance policies, I don't want to be the guy that they just stop, that they think, well, he was just my insurance guy. I want to be their quarterback. And you guys should want to be that with your key investors as well, in my opinion. You should be the guy that they're going to call. Like, he's my real estate guy, but he always has the right answer. Or he knows who's going to have the right answer. And so they pick up the phone and call you. You want to be that person in that relationship. All right, I think I'm behind because I got on a pedestal there. All right, from Chris, can you do a short example of how many times you can use the money in the policy as collateral? I mean, how many ramp up years, how much invested, and then ready to use? So using a numbers example might be something I'll just need to send to you directly, Chris. So if you want to reach out to me, it's just Gary@GaryPinkerton.com. So, and that's basically on that little brochure we just did. But essentially what I can say without the numbers is that you can borrow as often and as frequently as you want. You can borrow $1,000 today and say, whoops, sorry, didn't actually want that, and send it back. You can borrow every day if you want to, $100 at a time. They'll probably think you're nuts and they may get mad at you, but there's nothing that prevents that from happening. As I said, I got 19 loans out. I've never stopped having loans out. Every once in a while, I pick up the phone and say, can you please send me $4,000? Because I'm looking at my real estate account here and it's going to get tight in Texas in this next month. And then when that little crisis is over, I send it back and everything goes well. So it's extremely flexible and you choose when and how you're going to send it back. I hope, Chris, that was big picture, but please, I will absolutely answer your question for you. How does, for Michael, how does one's health or lack of play, or how does one's health or lack of play into policy approval and underwriting? It has a huge impact on it, but also one of my prides is that I can always be creative enough to solve this for any individual and their family. So do you have family members we can put it on? Do you have your spouse? Do you have descendants? Do you own a business and do you have people who are key members who are working for you that you can put the insurance on? I've been stopped one time and it was one of the saddest examples of the family situation was the saddest thing I've probably ever come across in a client situation. We tried 17 times and we did not succeed. But that's the only time I've come anywhere close to that. Specifically for that individual, life insurance can be a stopping point, but then there's other ways to achieve that as well. There's annuities, right? I mean, that's a charged word. A lot of people think that annuities are bad. It's just math. I'll show you the math that Mr. Fisher is just trying to sell mutual funds. He's wrong about the math. Anyway, but life insurance, I've been able to solve it to put these banking system policies in place for most people in most families, regardless of their health. Great question on that one. And thanks, Melissa, for pushing out the email address there. I've got an ebook there that you can have for free that talks more detail about this, and that may help with Chris's example there. I mean, Chris's question with the examples. And then I also participated in a book called The One Thing That Changed Everything. It's Kyle Wilson. He ran Jim Rohn's program, his entire company for many, many years. Wonderful, tremendous friend of mine. That book is also linked there, and I would happily send you an electronic copy of that one. My story is 4 pages long. It's very enlightening about me and what drives me, but there's like 32 other stories there from some pretty amazing people. I'd be happy to send you a copy of that as well if you reach out. Melissa, what am I missing, and how much time do I have? Did I have an hour?
We have, let me check. We have until 1:45. So
tremendous. All right.
If anybody has any more questions, we can keep going. It's been very informative.
And I could jump back into a little bit, maybe try to help answer Chris's question a little bit.
Yeah, go right ahead.
Okay. So I'm kind of looking down at another screen, so I apologize for that. So what I'm going to show you here is, I had these a little bit out of order, I guess. So this is a 40-year-old male, and he's going to contribute $20,000 per year. His minimum is going to be $5,000. His maximum is going to be $20,000. And in the first year, like Danny said, he could put in about $50,000 total. So you could really juice that extra part in the first year if it makes sense. And so you'd have access to 44, maybe 45,000 of the 50 on day one if you wanted to do it, you wanted to design it that way. And his ongoing minimum is only about 5. So I see a question there from Mohammed. I will try to get to that one here in just a moment. So those were kind of the entering parts of it. So here is an illustration. This happens to be Penn Mutual, one of the companies I do a lot of work with, mainly because they're flexible. I choose a couple of other companies. I work with 10 mutual insurance companies, and they're all fantastic, and you've heard of all of them. And I pride myself in fitting this policy like a glove on each person. Everybody's hand's different. Everybody's needs are different. Sometimes I go to one company, sometimes I go to another company. This one happens to be Penn Mutual. And like I said, it's a $20,000 contribution. And so over the years, you'll see initially here, he's got a little bit of limited access that you'd see here in year one to some of that part. That's that blue part I talked about, that there's going to be a little limited access. Why is it limited? It's because the insurance company is holding that back, growing the profits from it, and using those profits to overcome their expenses. Some of it is the benefit they provide me if I help put this in place for them. Some of it is the underwriting, the medical, things like that. All right. But you can see that it still lags a little bit in year 2. And then in year 6, in this guy's example, there's more in there than he's contributed. My contribution is actually wrong. It should be 120. Right. And so you'll basically see kind of tables like this, how much cash is in there based on what he's contributed, how much insurance is there. But this gives you a feel for what this kind of thing looks like for a 40-year-old person. So Then I said, what happens if you accumulate this money in life insurance for 20 or for 30 years, I guess, right? And at the end, the individual, I know these numbers are hard to see, but he'll have $1.3 million, and that's an internal tax-free rate of return of 5.37. If you tried to do this in a savings account, you'd have to earn 8.6%, excuse me. You'd have to earn 8.6% so that you could pay the taxes on the money, right? So you'd have to pay a bunch of taxes to end up with the same amount of money is what I'm trying to show. And 8.26% in a savings account for 30 straight years today, I mean, it's just a non-starter, right? And so I go on and I show the same kind of thing about a managed account. So I'm just going to leave the numbers up here for you to kind of think about them for a moment. I'm going to answer Muhammad's question and then I'll come back to it. So Muhammad asked, hey, if we already have life insurance with another company, then how can we switch if you switch with me, I guess, really to go this route. So there's a thing called a 1035 tax deferred exchange. And it's the same thing as 1031 tax deferred exchange for real estate. So if you have growth, you have gains that you don't want to cash it in, lose all the benefit, the basis and all that kind of stuff, you can actually move it over to a new account and one that's designed this way and move with it there. One of the things though and I do that a lot with universal life insurance, because very frequently universal life insurance has been put in place in a way in which people have underfunded it, and you're allowed to do that with universal. And it's going to implode on people, but yet they still have cash, so they want to get it protected. I don't do that a lot with whole life insurance, frankly, Muhammad, because often whole life insurance is hard to do wrong. It may not be efficient early on, but if it's been around a few years, I typically leave it in place and we just start another new one. But what I do is I promise you, I'm not going to churn those old policies into new ones to make money on you. If it makes sense, I'll show you side by side all future dollars you put in, where's it best put to work. And we're only going to do it if it makes sense to you, right? There's a lot of people out there that have given my industry a bad name because they're like, oh, his policy's junk, you should do my policy. And they're just making money on commissions. And it causes good people like yourselves to get a bad impression about what people are doing in this industry. So, okay, Muhammad, answer that one. And I'd have, really the answer is I need to look at it to be able to tell you if what you have is gold or if you need to change it. Great question. Okay, I'm moving forward a little bit. So this is the buy term and invest the difference version. So if I can't get 8% in a savings account for 30 straight years and then pay the taxes on it, then let's move the money into a managed account. So my broker said, instead of that life insurance stuff, I'm just going to put my money into this. And so we go down that path. And so now he's going to charge me I said 1.7% management fee. The reason I chose that is because Dalbar, who does an annual study, came out and said, for anything but retirement accounts, 1.7 is about as well as most people are doing when you're looking at trading costs, managers fees, all those things. So I just threw this number in. Retirement accounts, it gets bigger because there's also typically a retirement company's management that layers on top of all that. And so in this case, now they got to do 10% in this account. And here's the thing. You hear people say all the time about buying term insurance and investing the difference in the market, but it's not an apples to apples comparison, because if I put my money in this location and was able to make 10% a year on it, I still can't go put it in your real estate deal, because if I take it out of here, it's stopped earning the 10%. And that's the big impact of the compounding side of it. Hopefully I didn't lose too many people on that one, but I thought that was kind of, that was important to cover that. So let me make sure that I'm still caught up. Okay. So this is just this is a quick, just side-by-side comparison. If we want to grow $1.34 million, making the same $20,000 a year contribution, these are the kinds of returns that you have to get. And that's just talking about growing the cash. It's not the privacy and the protection and the death benefit in the background, right? The one on top is the only one that brings the death benefit. Okay. I did the savings comparison. This is just a roll up. So this one goes and uses real estate and invests in real estate. And I use some calculators, but it does really the same thing. It's going to show you essentially the same thing we just talked about. And so I'd rather pause for questions before I jump into more calculators. So let's just give it just a moment here on that. Happy to answer questions about, how do I design these on kids? How do we, does it work on your parents? It absolutely does. How flexible is it? How liquid is it? It's somebody calls it, somebody that I would listen to once called it the Swiss Army knife of financials. I wouldn't go quite that far, but it's a pretty flexible vehicle. It's pretty flexible. All right. Somebody's reaching out here, I think. Okay. Yeah, interested in how it'd be designed for kids. Why would I not bring that up? Thank you so much for bringing me back on, Melissa. So we're talking about legacy, right? So one of the challenges about storing extra cash in is that, we want to dump as much cash as we can. Well, this stuff brings life insurance when you dump the cash in. And so one of the things that actually makes it a challenge with children is that the life insurance that comes with it is so inexpensive that people will come to me and say, I want to put $10,000 a year in one of these for my children. That's hard to do. It's not impossible, but it's hard to do, especially if you don't have any insurance at all in yourself. So I have for my own children, and I do for clients all the time, put 6 to 10,000, let's say, into one of these. So it's comparable to what you can do in a Roth IRA for children. What I love doing for it, because I love saving taxes and reducing taxes and kind of putting our government on a little bit of a diet, if you will. I love having my kids work for me in my business and taking money that otherwise would be taxed at my income and paying it to my children for them learning how to do work. But I pay it to them inside their life insurance policy. So I took money that was going to cost me 37% federal or 35% or something federal and 9% in this beautiful state that I live in here in New Jersey. And some other fees, right? And I get it to come tax-free into my family. And then it gets paid to my children because they did work to earn it. And the first $12,400 last year went tax-free to them. And then it goes tax-free into their life insurance, which will pass to their kids, grandkids, great-grandkids, all tax-free, right? I've also started, I gave a portion of my business to my father-in-law so that we could pay some taxes at his tax rate because he participates and he deserves to have some ownership in the business. A lot of this stuff I've learned from Tom Wheelwright's team and some others. Love to talk to my clients about it and what I would do or what I've done in the past, not what you should do, since clearly I'm not licensed. But it's one of my favorite topics. And it digs right into how do we use this for kids. Here's another great reason to use it for kids. A buddy of mine tells a great story. He says that his 6-year-old boy had a bicycle, but it was a little kid's bicycle, right? It had the training wheels on it, and all of his friends were getting big boy bikes, and he wanted a big boy bike. But they were hesitant because his other bike was just such a nuisance. It was always back behind the car and just about to get ran over in the driveway. And it was always out in the rain, and it was rusty, and it was sitting in the garage when you try to pull the car in. And his son never paid attention to it. And so he said, well, listen, you've got the money. We've been saving the Christmas money and your chore money and stuff, and it's in your bank. But we have to, the way we access our money is you got to pay back the money to your bank because we value not giving away that money forever and what it could have done for us in the future. So you got to pay it back. Well, he's like, one of the unexpected things is that his kid's new bike that he has to do his chores to pay back every month, right? It's never in the rain. It's never rusty. And he runs to the garage sometimes and says, Mom, don't back over my bike, So it teaches our kids to value what they're doing. And my kids are using theirs for college, and it's their own money that they're going to hopefully get better grades because they're burning their own money doing this, and they got to pay this back, right? It's not free. It's not free money. So I've found personally great value in doing it that way. So, and then I guess the last thing, since this is legacy, and Melissa was nice at bringing me back into the fold there with the original topic, is that passing legacy, Rockefeller taught us that passing legacy forward, and what people with family offices do today is that they use a combination of trusts and life insurance inside those trusts to be able to grow money in a tax-free environment, have your vision and your desires live on beyond you, because the trustee has your written word that you said, before you passed. And so your money can live on without you or beyond you, without worry of it going away in taxes. And your experience and your knowledge and what's important to you and what it can be used for can live on beyond you as well. Again, I mentioned my great friend, Aaron Chapman. He's a mortgage broker to end all mortgage brokers, and he's done most of my deals, and he's taught me about a lot in life. One of the things that he's also taught me is that he's created a trust that he has life insurance policies for all of his kids, and I now have that as well. And then his children, as they become adults, they build their own family, they have their own trust, and they have to replicate over there what he's doing here. And if they do, and they, learn from his experience and they treat their money well in their trust, they get to access his when he no longer needs it and passes it forward. So Go check out aaronchapman.com, I guess, if you want to learn more about that guy. But he's enriched my life tremendously, as has Pat Donahoe at Paradigm Life. So I'm a talker, folks. I'm a talker. I will keep talking. Throw me some questions. I also need to take a breather.
Great. I think we had a few more questions in the
Oh
Q&A
my gosh,
box.
we did.
Yep.
I didn't scroll down.
No, that's okay.
So Garrett, you said that you have not paid back any of your loans yet. 5-year repayment term on that example. Yeah. So what I should have said is I have not fully paid off any of my loans yet. Most of my loans I set up to pay back at 10 to 12 year point, because that's what the cash flow from my real estate drove. $200 a month is what it drove to pay those loans off. Great question. And thank you for having me clarify that. Please share on the children age 6. Got it. Hopefully, Dawn, I did, and reach out to me independently if you mean more like show me a picture or show me what the policy would look like. When is the money taxed? So it's never taxed if you do it right. So you can borrow against it. You can access it throughout your life. You can even withdraw money if you want to. You can withdraw up to what's called basis, and basis means what you've contributed throughout time. So if I'm contributing $20,000 a year for 30 years, I've contributed $600,000 to this thing. It's where I've made my primary savings source for the family. And then at 65, like a light switch, I decide I'm going to start living on this stuff. And there's, 1.3 million or whatever that was in that policy. And so you start living on it. Well, you can live, let's say you live on 50,000 a year, right? You can do that up until you've pulled out $600,000. And that's considered a return of your premiums, the first dollars coming out. And then after that, all the rest of it's profit. And if you physically withdraw it, yeah, you'd be taxed on it, but just borrow against it if you want to. Or if you're in a low enough tax bracket, maybe it comes out tax-free for you, because you're below your threshold. But however, you can access it throughout your life tax-free. And then when you pass it as a death benefit, the remainder is a death benefit to your kids or whoever your beneficiary is, it goes tax-free. So if you operate it correctly, and everyone I know does, it passes tax-free. Dawn asked, do kids accounts affect finances for college FAFSA? No, and it's the only thing that doesn't. My oldest son just started college this year, and so last year we were going through that, and I'm telling you, it is painstaking to go through FAFSA. I have to put everything in mind that's on my tax form, and then I got to add back in everything that the U.S. government gave me credit for, except I did not put anything about the money that I have, the substantial amount that my family has in life insurance in there. And then when my son did his part, the same thing. Money he had stored everywhere but there didn't get affected. And then we went and did the one that I can't remember the name of, but it's for the Ivy League schools. And I've always heard that, well, sadly it does affect there. It doesn't affect that one either. It's darn near an identical form. So great question. And yeah, I didn't talk about it. And there's people in my industry that have built their practices around working with families who have kids going into high school to set up their finances so that they have a better opportunity to get, government financing and grants. What companies, life insurance, do you offer? Which one's your favorite? So I work with, I'll just name the ones that I normally work most with. So Penn Mutual Life Insurance Company, Mass Mutual Life Insurance Company, that's the biggest one in the country right now. American United Life, you may know it better as One America Corporation. Then a bunch of others that I don't work quite as much with. New York Life, I own all of those myself, on my family. And then Guardian, Meritus, Ohio National, Lafayette, and a few others that I work with, but not quite as often, because these others, the ones I mentioned first, they embrace it very much. And thanks, Michael, for the shout out there.
There's a couple more questions in the chat box, but you guys have Gary's email. We're running out of time here. We've got about a minute left. So just maybe a final thought or two, and then we'll wrap it up.
What keeps me up at night as an investor? Nothing. I got to tell you, there's some things that do keep me up at night, but building the pyramid the way I built it, I'm not worried about dying with a ton of, and I used to be worried about millions of dollars of debt if I become an investor and my family, being left saddled with that debt. And they're not going to be, because millions of dollars of tax-free life insurance is going to step in and pay it off. And it's not just about the life insurance though. It's that the people, I mentioned my comment about who I've set myself up with. I invest based on reputation there, Mr. Randazzo. And so I don't worry about it. There's nothing and it's just an amazing place to be in life. I appreciate that question though. And I probably missed some others, but thank you, ma'am. I honor your time.